Hello everyone, welcome to the 11th video of me learning how to trade using Forex. So in the last video we covered how to develop a trading plan and optimizing your trade entry and the techniques of successful traders, the intermediate course on forex.com. Today we're going to start looking at risk versus reward lesson, so let's get started. Risk versus reward. Successful traders won't enter position unless they know precisely where they're going to exit it, whether profitable or not. So, successful traders won't enter a position unless they know precisely where they are going to exit. Whether profitable or not. So know when you're gonna, if you're going to start a position or trade, know where exactly you're going to exit. Determine the planned closing level, so use a risk-reward ratio. This is determined by using a risk-reward ratio. What is a risk-reward ratio? A risk-reward ratio is a central part of trading successfully. It determines how much you're willing to risk losing on any trade, and how much potential profit you need to justify that risk. So risk reward ratio. How much you're willing to lose on any trade, and how much potential profit you need to justify that risk. In doing so, your ratio would dictate two crucial parts of your day-to-day trading: whether to trade an opportunity or leave it be, where you close to take profits or prevent losses. This ratio will determine two crucial aspects: whether to trade an opportunity or leave it be, or where you close to take profits or prevent losses. Where to close to choosing opportunities. When you trade using a risk-reward ratio, you should only open positions that fit your plan. There is no golden ratio that will work for every trader. To choose your own, you will need to balance how much profit you can realistically expect from any individual trade against how often you believe you can trade successfully. Balance how much profit you can realistically expect from any individual trade against how often you believe you can trade successfully. So, how much profit particularly expect from any against how often you believe you can trade successfully. Example, if you choose a 1-to-1 ratio, for example, then you'll want your potential profit from a trade to be equal to how much you're risking on it. If you could lose 250, you would target £250 profit. In this scenario, you need to be successful more than 50% of the time to make a profit. Any losing trade will cancel out a winning one, which doesn't leave much margin for error. Lose, win, lose, win, lose, win, win, lose, win, lose. With a 1-to-2 ratio, on the other hand, you can earn a profit even if you aren't 50%, or even if you aren't right 50% of the time. It would take 2 losing trades to cancel out each win. Lose, win, lose, wait, so equal to how much you risk in it. So 1-to-2. So if you could lose £250, you would target a £500 profit. Setting realistic profit targets. The higher ratio, the more often you can afford to make the wrong call. But how much can you expect to make from each position? Achieving a close profit target is more likely than hitting a distant one. So a 1-to-3 or 1-to-4 ratio will generally result in substantially fewer winning trades than a 1-to-1 or 1-to-2. Much will depend on your trading style. Day traders, for example, might need a lower risk-reward ratio. Achieving large profit within a single day is tricky. Using longer-term positions, meanwhile, means you can target higher rewards. With a ratio in place, you'll be able to make an informed decision about each potential position. Can the opportunity deliver the return outlined in your plan? If it doesn't, then move on to the next one. So you will need to lose. Basically, if you're going to lose an amount, you will need to try to get as much profit from that amount as possible then. Isn't that what they're saying? But if you're a day trader, then you might want a lower risk reward ratio. So like this sort of ratio basically, instead of this sort of ratio. I think that's what they're saying. Closing positions. To control the risk on each trade, you can use stop losses. You'll want to place your stop loss at a point where your prediction has been proven wrong. So place stop loss to a position where when your prediction has been proven wrong. At the point for example, if you're finding positions using pullbacks and breakouts, then your stop loss will be set to where a fake out will be confirmed. Alternatively, you could place your stop just beyond the recent support if you're going long, or resistance if you're short level. That way, if the market begins a substantial move against you, you can limit your losses. Taking profits. With a step in place, the level at which you take profits is determined by your risk-reward ratio. With a stop in place, for example, if your ratio is 1-to-2 and you've set a stop loss 20 points below your market entry, then you would look to exit at 40 points of profit. Because it's double, so you have to times that by 2. Because you're risking 20 points for 40 points. You might want to consider adding a take profit order to automatically close your position at your chosen level. That way you know you can secure a return if the market hits your target. How much can you risk? Your risk-reward ratio will go a long way towards helping you trade successfully, but it won't stop you from losing all your equity if you risk too much on each trade. As we covered in strategies and risk course, if you allocate 10% of your balance on each position, then you only need 10 consecutive losses before you are wiped out. Drop that down to 2% and you have a much larger margin for error. Test your knowledge. You have an open position with a stop loss 90 points below your entry level, and your risk reward ratio is 1 to 3. Where should you aim to take the profits? 270, because you times by 3. If your risk reward ratio is 1 to 1.5 and you want to earn 7,500 from a trade, how much should you be willing to risk? 7,500 divided by 1.5, that is... Wait, it was 7,500 divided by 1.5. 5,000. Running profits. One of the first rules of trading is to cut losses early while letting profits run. But how do successful traders put this into practice? Running profits is an easy concept to grasp. When you have a successful position on a market that's moving in your favour, keep the trade open to squeeze as much return from it as possible. But when the markets are moving fast, it can be tricky. After all, you don't want to keep position open for too long. You might see your profits diminish or even turn into a loss. A good guidance to start with is to stick to your trading plan as much as you possibly can. If you're a beginner trader, then letting winning positions run to their profit target can be difficult, let alone keeping them open for even longer. However, if you notice that your profitable trades have earned you more if you let them run, then you might want to consider actively managing positions. Actively managing positions. Actively managing your open position requires a more hands-on approach than sticking to your trading plan. Instead of closing your trade when it hits your profit target or maximum loss level, you shift them to reflect changes in the market. The most common method of achieving this is to adjust your stop loss. Once your position reaches a certain profit level, you move your stop closer to the current market price. This is instead of closing your trade automatically, you shift the most common method of achieving this is to adjust your stop loss. Once your position reaches a certain profit level, you move your stop closer to the current market price. This reduces your potential loss from the trade and eventually means you can start to lock in some profit, enabling you to target a higher total return. Tip: you should only ever move your stop loss in the direction of your trade. On a long position, only move the stop loss up. When going short, only move the stop loss down. Moving your stop in the opposite direction to allow the position more room can be a recipe for disaster, putting you at risk of large losses. Traders will often begin by moving their stop loss to the point at which they entered the trade. When your stop loss is equal to your opening price, you won't see any losses from position, even if the market reverses, unless it gaps past your stop. Example: you open a buy position on gold at 1,900 and a stop at 1860 and a take profit at 1980. Gold's price rises to 1940, so you move your stop to 1900 and take your profit. Your take profit to 2020. If gold reverses back to 1860, then your stop will trigger at 19,000. If gold continues to rise, then you could keep managing your position to start locking in profits. When should you move your stop? Some traders only move their stop in specific conditions. For example, they might wait for the market to hit a new price plateau, break a key support resistance level, or move into a consolidation pattern. Alternatively, you can decide set levels at which to move your stop. You could, for example, move your stop loss whenever the market moves by 50% of your initial risk total. In our example above, your risk total is 19,000 minus 1860, so 40 points. 50% of 40 points is 20, so you move your stop loss up 20 points whenever gold moves up 20 points. Scaling in and out of trades. You might also want to consider scaling in and out position to increase profits or realize returns. Scaling into trades involves adding new positions to increase your exposure to a market that is moving in your favor. Scaling out involves progressively closing out parts of an open position to realize profits early. We'll cover both in more detail. Okay. Test your knowledge. You're planning on moving your stop loss down 50% whenever your short EUR GBP position earns 50% of your risk total. You open your trade at that 0.9040 with a stop loss at 0.9064. When would you move your stop? 50%. $64 minus 40, that's 24. 24 divided by 2, 21 plus 21, 60 minus 21, I mean. That is, what's that minus 21? 90, that's none of them. Okay. You're planning on moving a stop loss down 50% whenever your short earns 50% of your risk total. You open your trade at that with a stop loss at that. You're planning on moving your stop loss down. Where would you move your stop loss? Earns 50% of your risk total. You're planning on moving your stop loss down 50% whenever your short EUR GBP position earns 50% of your risk total. You open your position at that, a stop loss at that. Where would you? Okay. Where would you move your stop to? Your stop. Right, okay. Tips for trading volatility. Volatility is an enticing prospect for traders, offering the opportunity of fast returns if you're willing to take an additional risk. When the markets are on the move, here are a few tips to help you stay profitable while keeping your risk in check. Use trend lines. Trend lines are an invaluable tool for trading volatility. Trend lines are an invaluable tool for trading volatility. They enable you to cut through the noise and see the underlying trend in the market, even when it's experiencing wide upswings and downswings. Before you consider opening position on a volatile market, draw some trend lines to ensure you know precisely how it's performing overall. It is also worth identifying where the key levels of support and resistance are forming, remembering that previous support will often turn into resistance and vice versa. Don't just follow the herd. One significant cause of market volatility is the herd mentality. As more and more traders jump onto an asset, they drive its price further. This causes more traders to join the opportunity, which only adds to the trend. While riding these trends can provide handsome profits, it's rarely a good idea to trade only because of FOMO, the fear of missing out on a popular opportunity. Instead, make sure you do your research properly. Once the herd mentality turns, things can get ugly quickly. Ensure jumping on a train only because of fear of missing out. Market price rises, traders buy the market. Its price rises further, traders buy, and it's going to be like that. Of course, you can take a contrarian view if you think the trend lacks substance. However, markets can remain irrational for a long time. So before you trade against the trend, make sure that the opportunity fits your trading plan. Take your position on news early. Take a position on news early. When major market events such as NFP, interest rate announcements and more occur, your best bet might be to stay out of any related markets entirely. However, if you do want to trade the fallout, you'll want to ensure their opening position before the release hits. Open position ensure you open your position before the release hits. To make this work, you'll need to do a lot of research so that you can make your own call on how the release will affect your chosen markets. It is worth checking any other related releases that might offer a hint to the final figure. If you're trading NFP, for example, you could try to get a gauge on the overall employment for the month by checking the ADP employment report, jobless claims and more. Once you're able to make an educated guess about where the release will land, you can decide how it might play out across the markets. Remember though, that analyst predictions for a release tend to be priced in early. If you think the analysts got it right, there might not be much volatility at all. Filling the gap. We've already seen how markets can jump from one price to another when trading is closed overnight or over the weekend. Often it will then fill the gap by returning to its previous closing price. So around here. In the above example, AUD/USD gaped 35 points over a weekend due to some poor economic data from China. But then over the next 12 hours it steadily climbed back to its original price. Simple way to trade volatility is to look for these gaps and trade the subsequent return to the pre-gap price. But just like any other strategy, it doesn't work every time, so be sure to place your stops and targets at reasonable levels. Trade the subsequent return for the pre-gap price. utilizing the gaps in markets to however doesn't work every time. US jobless claims some of the claims comes in above US jobless claims come in above expectations in July. Would that signal that NFP will come in high or low? What does NFP stand for? What does it? Trading. Non-farm payrolls report. Come in above expectations. High? No, it's low, isn't it? Come in above what would that signal? I don't really know what the NFP really is. Non-farm payrolls. The FTSE 100 closes at 6,900 on Friday, then opens at 6,950 on Monday morning. How would you trade to fill the gap? You would short the FTSE. So you sell it for a lower price and then buy it back at a higher price. Okay, tips for trading volatility. That is all done. Techniques of successful traders, or techniques of successful traders. That is all done. Very good. On to the next one. Fundamental analysis. Introduction to fundamental analysis. In this course we're going to cover everything you need to know about fundamental analysis, one of the two main methods of researching opportunities alongside technical analysis. What is fundamental analysis? Alright, so layout below. Fundamental analysis. What was it? 12/01 2024. Right, okay. Introduction to fundamental analysis. What is fundamental analysis? Fundamental analysis is a method of evaluating the markets that use multiple data sources to find an asset's fair value. Is a method of evaluating the market that uses multiple data sources to find an asset's fair value. Fundamental analysis is a method of evaluating the markets that uses multiple data sources to find an asset's value. Fundamental analysis. A method of evaluating the markets that use multiple data sources to find an asset's fair value. Unlike technical analysis, which looks purely at price action, it builds up a holistic picture of a security's strengths and weaknesses. You'll often hear fundamental analysis mentioned as a method of finding stocks to buy, but in truth it is used by traders in multiple different asset classes. In Forex, for example, a fundamental trader would examine any data that is likely to have a significant bearing on the price of a currency pair, such as economic data, political factors, or even the impact of natural disasters. Fundamental traders don't just look at data randomly though, they try to assess a market's fair value, so they can see whether it is currently underpriced or overpriced. Right, okay, so fundamental analysis and fair value. Fundamental analysis is based on the idea that each asset has a fair value, and that while the markets may temporarily overprice or underprice an asset, eventually its price should normalize at that fair value. Say you analyze a company and decide that it is worth more than its current share price. You can buy its stock, then sell it once its price catches up to the value that you have attributed to it. There are countless factors you can consider to decide whether your fair value for the company. You can analyze its earning reports, predict whether profits may rise in the future, or you can look at various geopolitical factors that may have an impact on its bottom line. For a currency pair, on the other hand, you might look at the economic releases, central bank actions, retail consumptions, or more. Drawbacks of fundamental analysis. Fundamental analysis provides a great way of familiarizing yourself with your chosen asset classes and sectors, and can help you find profitable opportunities, but there are two main issues you should be aware of. The first is that there is no guarantee that a chosen market will gravitate towards its fair value. No guarantee that your market will even if you research it thoroughly. For one thing, an entirely unpredictable event such as a natural disaster or scandal could wreak havoc on both your assets prices and your estimate of fair value. Or the market may remain irrational in its pricing for longer than you can keep your position open. The second is a vast amount of data at play across the global markets. With so much to consider, how do you decide what is worthwhile and what isn't? The amount of data. Vast amount of data in play around the globe. How to decide which info is important. One method of overcoming this issue is to take a top-down approach. Start by looking at the overall economy before deciding which markets may be overvalued or undervalued. Then take a look at the specific factors surrounding a handful of assets so you can take your positions. Major factors in fundamental analysis. As we've seen, the sources available to fundamental traders are vast and varied. However, there are a few that are more important than the others. Central bank announcements. Central banks can be a cause of significant volatility across most asset classes. Their most important action is to raise or lower interest rates, which can have a big impact on currencies, stocks, indices, and more. However, fundamental analysis also watch for new monetary policies, or hints that a central bank's stance may change in the near future, asset purchases, currency revaluations, changes to personnel, and more. So Company earnings. Listed businesses must release regular earning updates, informing investors of their revenue, profit, costs, and more. For stock traders, these reports offer invaluable insight into how a company is performing, as well as how they might perform in the upcoming months and years. So this is the company's performing. Economic data. Almost every asset is affected by its wider economy, so fundamental traders will look for signs that an economy is growing or shrinking. The key indicator of economic growth is gross domestic product, which calculates the sum of goods and services produced within a country economy. However, unemployment production reports are also important. The key indicator of economic growth is GDP. Inflation. Another key economic factor is inflation. Inflation occurs when the purchasing power of a given currency decreases, and central banks usually have the job of keeping it in check whilst avoiding deflation. When the purchasing power of a given currency decreases. Whilst avoiding deflation. Inflation doesn't just affect Forex. Bonds, commodities, companies and indices will all see volatility from it. Politics. Political change within a country can play out across financial markets. A new president, for example, might make life harder for businesses or invest heavily in new infrastructure. Geopolitics, too, can be important. For instance, increased conflict in the Middle East can put a strain on the world's oil supply, which will then drive up its price. As a result, businesses that rely heavily on oil may see their profits weaken. Drive up its price. Natural disasters and seasonality. These two factors may seem unrelated to the markets, but will often drive volatility across multiple assets. Natural disasters can bring headwinds for businesses and economies, as well as affecting supply of various commodities. Seasonal weather issues can do the same. True or false, you can only use fundamental technical analysis when looking for opportunities. FTSE 100 is trading at 6,500. You believe that a few position positive earnings reports from key constituents will soon drive up to 6,600. Is the FE underpriced? True or false? The financial markets only price assets based on their value today. True. No. False. Okay, so central banks. Whether you're trading stocks, forex, commodities, indices, or something else entirely, it is likely that the price of the chosen markets will be affected by the actions of central banks. What are central banks? Central banks are institutions that are responsible for managing the monetary system for a nation or a group of nations. Central banks. Monetary. They have a range of responsibilities, including overseeing monetary policy, keeping inflation in check, ensuring high employment levels, and maintaining currency stability. In addition, central banks will issue currency to control money supply, function as a bank of the government, regulate the credit system, oversee commercial banks, manage exchange reserves, acts as a lender of last resort. However, to traders, the most important action from central banks is changing interest rates as part of monetary policy. Major central banks. Almost every economy has its own central bank, but traders pay most attention to the ones attached to the most traded currencies. US Federal Reserve Bank, European Central Bank, Bank of England, Bank of Japan, Swiss National Bank, Bank of Canada, Reserve Bank of Australia, Reserve Bank of New Zealand. Central banks and interest rates. Central banks must maintain a tricky balancing act. If the economy grows too quickly, then rapid inflation will make prices too high for consumers. If the economy grows too quickly, then rapid inflation will make prices. On the other hand, if it grows too slowly, then unemployment will soon follow. The main mechanism to have to keep this balance is in check is the base interest rate. How do interest rates work? Interest rates work by either encourage saving or spending. With a trickle-down effect for the rest of the economy. Businesses borrowing money to grow their bottom line, and individual buying houses are vital to a growing economy. Lowering interest rates encourages both, resulting in growth. But when the growth gets out of hand, it can lead to excess inflation. It can even cause reckless spending that risks an economic crash. By raising interest rates, central banks can slow things down. If interest rates are low, the reward for saving is relatively minimal and it's cheaper to borrow money. If interest rates are high, investors will typically save money to earn interest on their money. Borrowing money is expensive. Example. Say for example that the UK economy is struggling. Banks are concerned about the situation, reluctant to loan out capital. They are scared they might not get it back. High interest rates. In this environment, high interest rates will encourage banks to hold on to their money. Why? Because they can earn a good return by keeping it with the central bank, where they will know is safe. so they will in turn charge higher interest rates on loans as they present a relatively higher risk. This makes it more difficult and expensive to borrow money. Small businesses may keep their purse strings tight, and prospective home buyers may be priced out of mortgages. Spending remains low overall, and the economy continues to struggle. High interest will encourage banks to hold onto their money. Why? Because they can earn a good return by keeping it with the central bank, where they will know it's safe, so they will in turn charge higher interest on loans, as they present a relatively higher risk. However, if the Bank of England reduces interest rates, holding on to capital looks a lot less compelling. Banks can no longer make much return from keeping money with the Bank of England, but can borrow it at low cost. That means they can offer low interest rates on loans to businesses and individuals. These loans are now worth the risk because there isn't a safer option readily available. With more access to cash and lower interest rates on their savings accounts, those businesses and individuals are encouraged to spend and invest. The high spending kickstarts the economy into growth. How interest rates affects the market. All of this doesn't just affect business and home buyers though, it also has a significant impact on traders. Let's take a closer look at how rates affect Forex and stocks. Forex. Like any financial asset, currency pairs are set by supply and demand. Investors will flock to economies with comparatively high interest rates because they can get a higher return. But to invest in foreign economies, you need to buy a currency. This will increase demand for a currency with high interest rates, causing its price to rise. Some investors take advantage of this relationship using a carry trade. In this strategy, you buy a currency with a high interest rate while selling one with a low rate. If you can earn enough interest to cover any fluctuations in the exchange rate between the currencies, then you can make a profit. Shares and indices. The relationship between the stock market and interest rates is less direct, but they still interact heavily. High interest rates decrease consumer spending and make it more expensive to borrow capital. Both of these outcomes tend to be bad for businesses, which means that the interest rate rise often hurts stocks and indices. Low interest rates, on the other hand, can boost stock markets by creating an environment in which businesses can thrive. They can access cheaper loans that enable them to expand the operations. In a low rate environment, savers will also get a poor rate by holding capital with banks, so they may be forced to invest in the stock market instead, further increasing demand for shares. However, traders and investors won't just wait until a rate announcement before taking a position. Instead, they scour multiple sources for any clues to what a central bank might do next. Central banks pay a lot of attention to various economic indicators when deciding the next course of action, so traders will also pore over these releases and attempt to second guess what is about to happen. They will also pay attention to the key staff at a central bank to ascertain whether important decision makers are hawks or doves. Hawks are propagants of higher interest rates to fight inflation. Doves want low interest rates to promote economic growth. You may also hear central banks overall described as hawkish or dovish depending on the policy at any given time. Because the market pays such close attention to central banks, any unanticipated interest rate move will usually be priced in long before it actually arrives. Major moves then often arises when a central bank confounds the market's expectations. The Federal Reserve is about to raise interest rates but announces that it is keeping them low instead. What might this mean for the GBP USD? No. The Fed desires to lower interest rates instead. What this might mean for it to rise, because more people are going to be buying it. If the Fed doesn't, what might mean for the gold's price? It will fall, right? Okay. I will need to read this again next time in the next video because that's a lot of information taken at once. I need to get my head around it. So, yeah, that's the end of this video. Thank you for watching. See you next time. Peace out.